Hello and welcome to PrivCap. I'm David Snow, CEO of PrivCap. PrivCap brings you smart conversations about the private capital industry, but in this presentation we thought it would be interesting to give you an overview of the very basics of the private equity asset class for people who are outside the asset class looking in. Now, some of you who know a thing or two about private equity may say, hey, now wait, it's not as simple as you present it. And I know that, but we are deliberately simplifying the basics of the private equity industry for the benefit of people who just want to get, again, the fundamentals of how it all works. Here's an outline of what you will be learning today. It is based on my having spent many years introducing brand new reporters to private equity as an industry, and I kind of drew a bunch of pictures and showed them how it all fit together. We will first be learning about the private equity firm, and then we will be learning about the private equity fund, which is where the firms get their money. And then we will be talking about private equity deals. These are the companies in which private equity funds invest. We will be talking about profit sharing, how the profits, if there are indeed profits, get divvied up. And finally, we will be spending just a bit of time at the end talking about very important themes in private capital and private equity today. In a nutshell, here's what private equity firms do. Private equity firms buy stakes in private companies with the hope of making a profit by later selling those stakes for more than was initially invested. So you hope to put $1 in, and you hope that what comes back is more than $1. Otherwise, the whole exercise has been one of futility. So let's start with the private equity firm. What are private equity firms? Well, it helps to create a fictitious private equity firm that we can call awesome capital partners. Private equity firms are basically partnerships. They are groups of individuals who band together to accomplish business objectives, sort of like law firms, maybe accounting firms. In this case, let's say that our private equity firm, Awesome Capital Partners, has 4 initial partners: Bob, Dan, Sally, and Doug. These are what are called general partners. So in private equity, there are general partners and limited partners. General partners are essentially the captains of the ship. They control the money and they do the investing, and they're the ones who hold forth themselves as being experts in investing in private companies. The GPs go out and hire maybe a handful of junior professionals to work at the firm, but of course the lion's share of the economics are shared among the 4 partners or the 4 general partners of the firm. Now let's talk about private equity funds. Private equity firms invest capital in private companies. Where do they get the capital? They often form the capital into pools of money called funds or limited partnerships, and they get the money from limited partners. These are often large institutions that invest in financial instruments, and in this case these are limited partners that invest in private equity funds. So they're called limited partners, and limited partners can often be public pensions. They are often university endowments. Sometimes they are sovereign wealth funds, and sometimes they are private families. There are other types of limited partners, but we're going to use these 4 as examples. So let's say Awesome Capital Partners wants to raise $500 million to go out and invest. Let's say they call their fund Awesome Capital Fund 1. That's their target. Now they have to go convince the limited partners that they know that they should commit capital to this fund. So let's say they are successful at convincing, let's say, a large public pension, maybe it's based in California, to commit capital to their fund. So the public pension says, hey, sure, I'll put in $200 million. You guys seem like you're really smart and capable. And then let's say the other limited partners all decide to come in. So the university endowment agrees to commit $100 million. The sovereign wealth fund from, let's say, a Middle Eastern country agrees to put in $150 million. And then there's a wealthy family, and they put in $75 million. So, hey, isn't it great? Awesome Capital Fund 1 actually managed to raise $25 million more than their original target. It's called being oversubscribed, and they kind of beat their chest a bit and say, hey, look how popular we are. We raised more capital than we even intended to. So now it's time to talk about private equity deals. The private equity firm has raised a fund. They now have committed capital. Now they're going to go out and invest in private companies, whether it's buying them or simply investing in them as a minority stakeholder. So private equity funds often take 10 to 15 years to actually go through the whole cycle of buying a collection of private companies and then selling them and distributing all the money. So let's say in the first year, Awesome goes out and invests in Widget Company. They invest $150 million in Widget Company. Then the next year, they go out and invest $100 million in Gizmo Company. Then another year goes by, and they invest $250 million in What's It Company. And finally, in the fourth year, they invest $25 million in Yada Company. So they've now invested the entire amount of their fund in 4 what are called portfolio companies, and it takes place over about 4 years. This is called the investment period, and again, the investment period is often 4 to, let's say 6 years. Now it comes time to harvest the investments, and you sell an investment in what's called an exit. So let's say in the 5th year, Widget Company is sold, and then in the 6th year, Gizmo Company is sold, let's say to a much bigger corporation. Then a few more years go by, and What's It Company is exited via an IPO, an initial public offering. This is a common way that private equity firms will essentially sell their stake in a company. In this case, they're selling it to the public in an initial public offering. Finally, what happened in year 11? It turns out that Yada Company simply did not go very well. The investment has been a bust. The company went bankrupt. These things happen. It's sad, but this is the exit outcome that private equity firms don't want, but as I say, it happens. So now let's understand how much these investments were sold for. So Widget Company was sold for $300 million, so that $300 million goes back through the fund. Gizmo Company was sold for $200 million. What's It Company in its IPO got back $400 million, and of course Yada Company was a wipeout, and so they get 0 back. Let's take a look at what this means as far as profit sharing. So if you remember, Widget Company took $150 million from the fund. Gizmo spoke for $100 million. What's It took $250 million, and Yada took $25 million. So that was the fund, the Awesome Capital Fund 1. How much came out of those deals? Well, when the deals were sold, Widget was for $300, Gizmo for $200, What's It for $400, and Yada was a wipeout. So the proceeds to come via exits was $900 million. Well, that means that the fund has been profitable. There's a $150 million profit from Widget, $100 from Gizmo. What's It? There's a $150 million profit. That has to be balanced against the loss from the Yada wipeout. But the overall profit of the fund was $375 million. And of course, not only do the investors in the fund, the LPs, get to share in the profits, but of course they get their money back. The money that they committed to the fund that flowed through the fund into the portfolio companies comes back to them, and that's very important to note. So there's a $375 million profit. Now we're going to talk about profit sharing or carried interest, which is the gravitational center of the private equity industry. The GPs, the captains of the ship, because of their hard work and presumably their talent, get to keep usually 20% of the profits generated from a fund. So 20% of $375 million is $75 million. You do the math. If you distribute $75 million among 4 partners and a handful of associates and analysts, that's pretty good work if you can get it. So it's the kind of thing that can make you quite wealthy, and that's why so many people want to get into private equity. And then the remaining $300 million in profits is distributed to the LPs, to the limited partners, on a pro rata basis based on how much they committed to the fund. And of course, as this is all unfolding, as the investments are being done, and usually as the exits start to come in, the firm is ready to raise its next fund. They go back to their limited partners and say, hey guys, we're doing a good job. We think we're going to generate nice returns, and we're getting ready to raise our next fund. Would you like to re-up? Would you like to recommit capital to now an even larger fund? And you'll see, because the firm has grown, they've even added a partner to their ranks. And so this is how private equity firms grow. Let's talk briefly about the most important trends in private equity today. They all end with an Asian. So there's 4 main trends. One is specialization. Private equity firms, having started out 20 years ago as more generalists, now have to be much more specialized in the industries that they focus on and the geographies that they focus on. And often that means that they bring in people who actually have run businesses in the sectors that they focus on. And this is one way that private equity firms try to distinguish themselves in an increasingly competitive landscape. Number 2 is regulation. Having spent years under the radar screen, private equity firms are now facing greater scrutiny from regulators around the world, and they are learning how to deal with learning how to deal with the expense and a headache, frankly, of being regulated entities, and so that's a big theme right now. Institutionalization is the third theme. private equity firms, now that they are managing trillions in capital from very large, sophisticated organizations, have needed to up their game. They've needed to become more sophisticated in the services and the resources that they provide back to their investors in order to make it a more institutional experience for the investors. And so this, of course, takes time, money, and attention. Finally, globalization. Private equity firms must help their portfolio companies become more competitive by becoming more global, by going into more markets. And one of the things that private equity firms like to say is that they can help their portfolio companies expand beyond their immediate borders and go into new markets. That is the overview of private equity from PrivcapTV.com. We hope that if this has been interesting for you and you have an appetite to learn more, you will come check out the great video and other kinds of content that we have at PrivcapTV.com that really goes into much greater detail about the private equity industry around the world. Thank you very much for tuning into PrivCap.